Australia's economy is growing at its fastest pace in 3 years, 1.2% in the last quarter and at an annual rate of 3.3%. But the picture across the whole of the economy is not quite so rosy. While mining and its associated construction projects may be booming, times are getting tougher for manufacturers. Here's Philip Lasker.
On today's numbers, Australians might be forgiven for thinking that the global financial crisis was someone else's problem.
All these numbers highlight just how different the Australian economic story is. I think we're going ahead at quite a strong rate. Certainly no signs of any double dip in the figures that we're seeing in Australia.
What we're seeing is an economy that grew 1.2% in the 3 months to June, the fastest pace in 3 years. Annual growth is now around trend, above 3%.
Mining is really the engine that's driving the Australian economy. It's really an economy that's firing on one cylinder at the moment.
A massive increase in the terms of trade of more than 12% thanks to the resources sector boosted the income side of the national accounts and flowed through to mining profits.
You can see it in the company profits data that was in today's release. You can see it in the capital spending data. You can see the way our trade accounts have turned it around. You can see it in the increase in wages and salaries coming through as well. And that income flow is going to support a lot of economic activity this year.
There were signs that government economic support was beginning to wane, while households, enticed by the discounts on offer, were ramping up their spending and dipping into savings. It was a surprising development given the Reserve Bank claimed households were helping dampen economic activity by saving more and spending less. Still, the economists saw it as part of a welcome shift.
But probably the most encouraging sign in today's data is the indications the private sector is starting to take over. That's exactly what we need to see to sustain the upturn that we have at the moment.
But there's at least one area of concern. The latest performance of manufacturing index fell to a 5-month low, with new orders down. The sector is battling a number of headwinds, including a hung parliament.
I think that created some uncertainty within manufacturing. I think import competition is still very strong, and of course the Aussie dollar is still pretty strong.
It was a different story for Chinese manufacturing, where the latest numbers showed a pickup in activity, which augurs well for Australian miners. So does all this strength mean earlier interest rate hikes?
Certainly there doesn't appear to be any immediate need to rush in and raise interest rates, but certainly the way the economy is evolving does suggest the next move is more likely to be up than down.
And if you look at the inflation scenario, I think it's much less threatening than perhaps it appeared a quarter or so ago, with, again, continued concerns in Europe and the US, but also the fact that you are going to continue to get some deflation imported through, Chinese goods and the like.
Certainly today's numbers banished any thoughts of interest rate cuts.